Let's begin with a question that sounds innocent, but is actually the most painful inquiry in modern finance. Why does the neurosurgeon lose money? Consider the profile of a neurosurgeon. This is a human being who possesses the highest tier of intellect. They have spent a decade mastering delayed gratification. They possess a discipline that 99% of the species cannot fathom. They can detach their emotions to perform life or death maneuvers on microscopic nerves. They are the apex of human capability. And yet, statistically, when you put that same neurosurgeon in front of a brokerage account, they are slaughtered. Why does the structural engineer, whose entire existence is based on calculating risk and load-bearing capacity, fail to manage the risk of a simple portfolio? Why do the smartest, most disciplined, most successful people in our society consistently underperform a brainless index fund? If you go to a bookstore or watch YouTube, the gurus will give you the comfortable answer. They will tell you it is a skill issue. They will say these people lack financial literacy. They will tell you they were greedy. They will tell you they didn't study the charts hard enough. That is a lie. It is a comfortable lie designed to sell you courses, because if the problem is a lack of skill, then the solution is something you can buy. But the reality is much darker. The reason the surgeon, the engineer, and you are failing is not because you lack intelligence. It is not because you are lazy. And it is certainly not because you don't know how to read a balance sheet. You are failing because you have walked into an environment that is structurally designed to hunt you. You are a biological organism evolved for the African savanna, optimized for linear survival, social cohesion, and immediate threat avoidance. You have taken that biology and stepped into a financial system that is nonlinear, mathematically extreme, and counterintuitive. This is not a skill gap. This is a species mismatch. This is not an accusation of incompetence. It is a calibration of reality. You are trying to play a game where the rules are written in a language your instincts cannot read. The market is not a mechanism for creating wealth. That is a byproduct. The market, at its core, is an elimination event. It is a machine built to eliminate human DNA. Over the next 30 minutes, we are going to perform an autopsy on your failure. We are not going to talk about moving averages or RSI. We are going to look at the mathematics of the system and the biology of your brain, and we are going to prove why, by default, you were destined to lose before you even placed your first trade. You are not failing the market. The market is doing exactly what it was designed to do. Let's strip away the noise and look at the raw architecture of the casino you are playing in. Most people believe that the stock market is a fair game where good companies go up, bad companies go down, and the average company drifts upward with the economy. This belief is the first nail in your coffin. We need to look at the data provided by Professor Hendrik Bessembinder. This is the most terrifying dataset in financial history, and yet almost no retail investor truly understands its implication. Bessembinder analyzed the lifetime performance of 26,000 stocks listed in the United States between 1926 and 2016. He asked a simple question: where did the money come from? The results were not just skewed, they were catastrophic. He found that the entire net wealth created by the stock market over nearly a century came from just 4% of listed companies. Let that sink into your marrow. 4%. That means companies like Apple, Exxon, Amazon, and Monster Beverage. What about the other 96%? They were statistically irrelevant. Collectively, the other 25,000 plus companies matched the return of a risk-free treasury bill. They were dead weight. They went bankrupt, they merged for pennies, or they stagnated for decades before vanishing. This is what we call a power law distribution. In a normal world, the world you live in, attributes are distributed on a bell curve. Height, weight, IQ, running speed. Most people are average, a few are short, a few are tall, but nobody is 10,000 times taller than the average person. In the market, average does not exist. The market is binary. You have the 4% that generate virtually all the returns, and you have the 96% that are essentially garbage. This is the structural trap. You are searching for a needle in a haystack, but you have been convinced that the haystack is made of gold. It isn't. The haystack is made of coal. Let's quantify the penalty of this distribution. If you miss the top 4% of winners from the dataset, the aggregate return of the remaining 96% of the stock market over the last century is effectively zero. This means missing the winners is mathematically terminal. You are not underperforming, you are holding cash in a burning building of inflation.
Now, why does this structure destroy you? Why can't you just find the 4%? Because your brain is biologically incapable of processing power laws. You are a linear creature. You evolved in a bell curve environment. If you hunt twice as long, you catch twice as much food. If you plant twice as many seeds, you get twice as much harvest. Your entire evolutionary history has taught you that effort equals reward, and that outcomes are generally distributed fairly. When you look at a list of stocks, your brain defaults to a normal distribution bias. You assume that if you buy a decent company with good earnings, it should give you a good return. You assume that the risk of picking a losing stock is balanced by the probability of picking a winning stock. You think it's a coin flip, but the math says it is not a coin flip. It is a lottery where 96% of the tickets are losers. When you construct a portfolio, you diversify. You buy 10, 20, or 30 stocks because that feels safe. That feels responsible. But because of the power law, diversification often works against you. If you buy 20 stocks at random, the probability that you have missed the super 4% is incredibly high. And if you miss the 4%, you are mathematically guaranteed to underperform a savings account. Your brain craves consistency. You want a stock that goes up a little bit every day. You want the paycheck. You want the linear reward. But the 4% winners do not move linearly. They move exponentially. And the 96% losers do not crash immediately. They bleed slowly. Your biology is looking for a steady slope. The market is offering you a cliff.
So, how does this combination of power law structure and linear biology actually eliminate you? It kills you through boredom and doubt. The market doesn't need to crash to take your money. It just needs to do nothing. Imagine you buy a stock. You have done your research. It looks good. But unknown to you, this stock belongs to the 96%. For 2 years, the stock does nothing. It goes up 10%, it goes down 10%. It goes nowhere. Meanwhile, you see a headline. Nvidia is up 200%. Tesla is mooning. Your linear brain starts to scream, effort should equal reward. I did the work, why am I not getting paid? You feel like you are missing out. You feel stupid. The chemical pressure in your brain builds up. You begin to doubt your thesis. You think the system is broken, or that you are broken. So what do?
You sell. You sell the boring stock to chase the one that is already moving. You sell the asset that was stagnant to buy the asset that is hot. And here is the cosmic joke. The moment you sell is often the moment the mathematical probability shifts. Many of the 4% winners spent years in the 96% graveyard before they ascended. Monster Beverage had drawdowns and stagnation periods that would make you weep. By refusing to accept that most stocks are garbage, and by refusing to accept that winners are rare, you churn your account. You jump from one piece of coal to another, frantically looking for a diamond, bleeding out in transaction fees and bad timing. The market filters you out by offering you a sea of mediocrity, the 96%, that is just large enough to drown your patience before you ever find the 4% island.
If the power law is the map, volatility is the terrain. And make no mistake, the terrain is mind. There is a fundamental misunderstanding about what volatility is. In the media, on CNBC, volatility is treated as a bug. It is treated as a sign of danger, a sign that something is wrong. The market is volatile today, they say, with a hushed, fearful tone. This is false. Volatility is not a bug. Volatility is a feature. More specifically, volatility is the price of admission. Let's look at the data from J.P. Morgan's Guide to the Markets. Over the last 40 years, the S&P 500, the index that everyone tells you is the safe way to invest, has experienced an average intra-year drop of 14%. Understand what this means structurally. It means that in an average year, not a crisis year, not a crash year, but an average year, you must be willing to see your net worth decline by double digits. But here is the paradox. In 30 of those 40 years, the market finished the year positive. This is the volatility paradox. To get from point A, January 1st, to point B, December 31st, with a profit, the price must traverse a valley of pain. There is no path around the valley. The valley is the road. If you look at the greatest winners of all time, the 4% we discussed, their volatility was not lower than the market, it was significantly higher. Monster Beverage dropped 18%, 22%, and 15% repeatedly before its massive run. Amazon dropped 90% during the dot-com crash and has had multiple 30 to 50% drawdowns since. Structure dictates high returns equals high volatility. The market is a mechanism that transfers wealth from those who cannot stomach volatility to those who can. It uses price swings to shake loose the shares from weak hands so they can be reaccumulated by strong hands. It is not just the depth of the cut, it is the duration of the bleeding. A 14% drop rarely happens in an afternoon. It is a slow, grinding water torture that lasts for weeks or months. The market stretches the drawdown just long enough to exhaust your psychological reserves, forcing you to capitulate days before the recovery begins. This structural reality crashes headfirst into your biological imperative, loss aversion. You are a biological machine programmed for survival, not for equity compounding. In nature, a loss usually meant death. If you lost your food supply, you starved. If you lost your shelter, you froze. If you lost your status in the tribe, you were exiled. Evolution did not optimize your brain to tolerate loss. It optimized your brain to react to loss with extreme prejudice. Daniel Kahneman, the Nobel laureate, proved this with the concept of loss aversion. He demonstrated that the psychological pain of losing $100 is roughly twice as intense as the psychological pleasure of gaining $100. When you see a stock you own drop by 14%, that average market breadth, your brain does not see variance. Your brain sees a predator. Your amygdala, the lizard brain responsible for the fight or flight response, hijacks your prefrontal cortex. It floods your system with cortisol. Your heart rate increases. Your palms sweat. You feel actual physical nausea. This is a biological error. The red number on the screen cannot hurt you. It cannot eat you. It cannot exile you. But your biology cannot distinguish between a paper loss and a physical threat. When the market drops, you are not making a financial decision. You are making a survival decision. You are in pain, and the fastest way to stop the pain is to make the threat go away. How do you make the threat go away? You sell. The moment you click sell, the cortisol stops. The anxiety vanishes. You feel a wave of relief. You tell yourself, I'll get back in when it's safer. You prioritized your biological need for emotional safety over your financial need for structural survival. The market knows this about you. It relies on this reaction to function. This is why stop losses are often the tool of your destruction, not your salvation. Let's go back to the aggressive trader scenario. You buy a stock. You set a tight stop loss at 5% or 7% because you want to be prudent. You want to manage risk. Structurally, what have you done? You have placed your exit point inside the noise. If the average random fluctuation of the market is 14% and your stop loss is 5%, you are statistically guaranteeing that you will be triggered. You are trying to ride a roller coaster with a seatbelt that is designed for a sedentary office chair. The moment the ride moves, the belt snaps and you are thrown off. The elimination mechanism here is brutal. The market drops 8%. Your 7% stop loss fires. You are out. You have taken a small loss. You feel smart because you didn't lose more. Then the market does what it statistically tends to do. It reverts. It bounces. It finishes the year up. You are left on the sidelines. You paid the loss, but you missed the gain. Do this 3 or 4 times a year, getting shaken out by normal noise, and you will bleed your account to death by 1,000 cuts. The Monster Beverage chart shows this clearly. If you had an 8% stop loss, the market would have kicked you out of the best performing stock of the century 3 separate times in just the early phase. You would have watched from the sidelines as it rallied 50,000%. The market eliminates you by using volatility to trigger your biological pain response, forcing you to sell at the exact moment you should be enduring. It demands a toll that your biology screams at you not to pay.
We have established that the math is against you. Power law. We have established that the movement is against you. Volatility. We have established that your own brain is conspiring to sabotage you. Biology. But there is one final trap, the deadliest one of all. It is the instinct that you believe will save you. It is the strategy that every financial advisor, every parent, and every textbook has told you is the right way to invest. Safety. What if I told you that your desire for safety is the very thing that guarantees your extinction? What if I told you that by trying to minimize pain, you are actually maximizing the probability of your financial ruin? In Part 2, we are going to dismantle the safety illusion. We are going to expose why diversification is often just diversification. And we are going to give you the only framework that allows a biological organism to survive in a mathematical slaughterhouse. The market is designed to eliminate you, but you don't have to die. Welcome back to the slaughterhouse. In part 1, we proved that the market is a chaotic system governed by power laws and violent volatility. Now we must confront the strategy you have been taught to defend yourself against this chaos. The strategy that feels intuitive, the strategy that feels responsible. Safety. Specifically, the twin pillars of traditional retail safety: over-diversification and profit-taking. Let's dismantle diversification first, using the structural reality of the power law. The textbook tells you, don't put all your eggs in one basket. Buy 30 stocks, buy 50 stocks, smooth out the variance. But remember the Bessembinder data. 96% of stocks are statistically irrelevant garbage. Only 4% create the wealth. When you blindly diversify, you are not reducing risk. You are engaging in a mathematical suicide pact called diversification. If you buy 30 stocks, the laws of probability dictate that you have loaded your portfolio with approximately 29 losers or zombies, and perhaps, if you are lucky, one winner. Structurally, you have diluted the potency of the 4% winner to the point of invisibility. Even if that one stock trickles, it cannot drag the dead weight of the other 29 safe stocks. You have constructed a portfolio that is mathematically designed to revert to the mean. And since the mean of the stock market, excluding the winners, is 0, you have engineered your own stagnation. Now consider the second pillar of safety: taking profits. You can't go broke taking a profit, they say. This is perhaps the most dangerous lie in finance. Structurally, the market is an asymmetric game. You will lose often, the 96%. You will suffer drawdowns, volatility. To survive the math, your winners must be outliers. One winner must pay for 10 losers. When you sell a winning stock after a 20% gain because you want to play it safe, you are surgically removing the right tail of the distribution. You are capping your upside while leaving your downside unlimited. You are playing a game where you accept all the risk of the crash, but voluntarily decline the reward of the rally.
Why do we do this? Why do we sabotage our own mathematics? Because safety is a drug that your biology craves. Your brain is addicted to certainty. In the chaotic environment of the savannah, uncertainty meant death. A rustle in the grass might be the wind, or it might be a lion. The brain that assumed it was a lion, the safe bet, survived. The brain that waited for confirmation died. We are descendants of the paranoid. When you see a profit of $500 on your screen, your brain views it as a fragile, uncertain resource. It is a bird in the bush. The amygdala screams, "Capture it, make it real," before the market takes it back. When you click sell, you get a hit of dopamine. You feel a rush of pleasure. You feel smart. You have converted uncertainty into certainty. You have secured the food. This behavior is biologically rewarding. It feels good to take a profit. It feels prudent to diversify. But the market does not care about your dopamine. The market is a system where the safe action, selling early, hedging excessively, is often the riskiest action in the long run. You are using short-term emotional soothing to solve a long-term structural problem. The consequence of seeking safety is not a spectacular explosion. It is not a margin call. The market eliminates safe investors through a much crueler method: the slow rot. You will not blow up your account. Instead, you will experience the death of opportunity cost. You will hold a portfolio of 30 mediocre companies. You will sleep well at night, But 10 years from now, you will wake up and realize that while the 4% of winners drove the index up 300%, your safe portfolio is up 15%. Adjusted for inflation, you have lost money. You have wasted a decade of capital compounding. You prioritized the feeling of safety over the reality of wealth creation. And the cruelest cut, you will likely watch the one stock you sold early, the one you took profits on to be safe, go on to become the next Monster Beverage or Amazon. You will watch from the sidelines, clutching your small, safe pile of cash while the wealth of a generation is created without you. That regret is the final elimination. It is the psychological scar that drives you out of the market forever. So, if aggression gets you killed by volatility, and safety gets you killed by mediocrity, what is left? How does a biological organism survive a mathematical slaughterhouse? We must redefine the goal. Stop trying to win. Stop trying to beat the market. Your only goal is risk of ruin equals 0. You must build a structure where you cannot be forced to sell. If you can stay in the game indefinitely, the power law will eventually work in your favor. If you stay at the table long enough, you will eventually be dealt the aces. The only way you lose is if you are forced to leave the table. This requires a shift from predicting, trying to guess what happens next, to positioning, being able to endure whatever happens next. How do we hack our biology to achieve this endurance? We cannot lobotomize our amygdala. We cannot turn off the fear response, but we can control the stimulus that triggers the fear. The tool is not a chart pattern. The tool is position sizing. This is the sleep well at night formula we hinted at. Most traders size their positions based on greed. How much will I make if this goes up? The survivor sizes their position based on pain. How much can I hold if this goes down? Let's run the biology of it. If you buy 1,000 shares of a volatile stock and it drops 20%, you are down thousands of dollars. Your cortisol spikes. Your flight response activates. You are biologically compelled to sell. You cannot help it. You are overpowered by your own chemistry. But what if you bought 300 shares? The same 20% drop happens, but the dollar amount is small. It is below your pain threshold. Your cortisol does not spike. Your amygdala stays dormant. You look at the drop and you feel indifferent. Indifference is a superpower. By voluntarily buying fewer shares, you have purchased the right to remain rational. You have lowered the volume of the market's noise so that your brain can actually think. This runs counter to every greedy instinct you have. But if I buy less, I make less. Yes, that is the trade-off. You are paying an insurance premium. You are paying the cost of potential profit to buy the certainty of survival. The market tries to eliminate you by forcing you to make decisions under duress. By sizing for survival, you remove the duress. You accept that you will not get rich quick. You accept that you will hold through 15%, 20%, even 30% drawdowns. But because your position is sized correctly, those drawdowns do not break you. While the aggressive trader is getting margin called and the safe trader is selling the bottom out of panic, you are simply waiting. You are holding the ticket. You are allowing the stock the breathing room it needs to navigate the volatility and find its way to the 4% promised land. This is how you checkmate the elimination mechanism. You don't outsmart the machine, you simply outlast it. You become the cockroach, not the lion. The lion starves when the game changes. The cockroach survives everything. Let's return to our innocent question. Why do the genius doctor and the brilliant engineer fail? They fail because they try to impose their will upon the market. The surgeon tries to fix the portfolio like a broken spine. The engineer tries to stabilize the price like a wobbling bridge. They use their intelligence to try to control the uncontrollable. And when the market refuses to be controlled, their biology breaks. The market is an arrogant teacher. It humiliates the intelligent. It bankrupts the proud. It does not care about your analysis. It does not care about your fair value. But for the few who understand the design, for the few who accept the power law, for the few who respect volatility as the price of admission, and for the few who size their positions to conquer their own biology, the market offers a path. It is not a path of excitement. It is a path of quiet, painful, boring endurance. The market is designed to eliminate you. It is expecting you to panic. It is expecting you to be greedy. It is expecting you to seek safety. Do the opposite. Accept the chaos. Widen your stops. Shrink your size. Stop trying to be smart. Start trying to be unkillable. Because in the end, the market doesn't reward intelligence, it rewards endurance.